Thank you very much, Jack, again. And once again, Ian will be going in a little bit more detail regarding one of these strategies that I will be diving into in a couple of minutes. The schedule or the agenda is the same. We're going to be focusing on market performance first, followed by best sectors and stocks, some single factor analysis and model performance overview, as well as we'll dive into the market fundamentals and the outlook. So hopefully we've all left Q4 2018 behind us. Looks like 2019 almost got all of the losses back, but we came in just a little bit short. What it looks like is that the first quarter has gained 13.1%. As you can see in the returns, just from a price return perspective, January was very strong, followed by February and March. So it sort of tapered off towards the end of the quarter. In terms of a total return on the U.S. market performance side, what you'll notice is it's sort of trending downwards, as I mentioned before. January was the strongest month, February was less so, and then March even had some negative returns from the S&P 400, which is representation of the mid-cap, as well as the Russell 2000, which is the small-cap index. But overall, we came in pretty strong for the first quarter, all in double digits across the board, with the NASDAQ coming in just short of 17%. This is the market breadth. So what we're doing is we're looking here at the percentage of stocks with a positive total return. What you can see here is also the same type of pattern. You can see that the strongest breadth was in January, so it looked like all stocks were coming in positive. So that's a very good confirmation of a rally, generally speaking. And then February followed by a little bit slower breadth numbers, and March came in to below 50% for some of the indices that we follow. But overall, what you can see is the majority of the stocks contributed to the first quarter's rally, with over 80% having positive returns across the board. All in all, it was a healthy rally for Q1. Q2 is still yet to see. But what we can see here on a year-to-year basis, we can see that the market breadth for the first quarter was above 90% for the first time since 2009. So it's been 10 years since we've seen this type of breadth. Hopefully it continues, but I guess time will tell. Taking a look at the breakdown of the gig sectors for the quarter one returns, what you'll notice is we've had positive gains throughout the board. What you also see here is that the healthcare came in at 6.6%. Obviously a different picture from what it is in Canada, as Jack just described, but at 6.6%, this is the lowest return out of all of these sectors. And the highest return was actually information technology, coming in at 19.9%. What you'll notice, and it was a little bit interesting to me when I was looking through the data, is that the best performer and the worst performer both came from consumer staples. It just goes to show that you had to be a real stock picker in that particular sector if you were trying to squeeze out some gains. This next chart you might have seen over the last few QMRs. We've incorporated it just to show a historical view of how the sector weights have looked like over the last 10 years or so. What you'll notice here is that on the bottom right-hand corner, you've got this, I guess, greenish sector. That was the real estate sector, as well as you'll notice that what has been shrinking throughout the years since 2009 and becoming a smaller and smaller part of the weighing in the S&P 500 is this energy sector up here. And that is represented by this purple shading at the top. Now on to taking a look at the top 50 and the bottom 50 stocks in the S&P 500. What you'll notice is that the majority of the stocks in the S&P 500 came from the information technology sector. As I mentioned before, that was the strongest sector, coming in at just below 20% returns. So quite a bit of names that you can recognize here. We've got Xerox, Intuit, NVIDIA, and some of the names that actually had significant downside during the previous quarter, so they came back pretty strongly. What we're doing here is looking at the relationship between the benchmark, in this scenario the S&P 500, and the best 50 stocks. So what you can see here is that the similarities between those stocks and the benchmarks in terms of the relationship, is that the earnings revisions were deeper to the downside, as is represented by this green line. Actually, sorry, my apologies. These red lines over here, they're revisions. These are represented by deeper to the downside. This center vertical line over here represents the particular index, the S&P 500. You'll also notice that we have quite a bit of green bars here in the valuation criteria. This means that those top 50 or best 50 stocks in the first quarter had cheaper valuations across the board, both on price equity, price cash flow, price to book, and price to sales. The other part that you'll notice, which has a drastic difference from the bottom 50 stocks during the previous quarter, which we'll take a look at next, is that pretty much all of these stocks have underperformed relative to the benchmark on those time frames. So it looks like, and you'll see it in the next slide based on the worst 50, it looks like the stocks that have underperformed the most during the previous quarter have actually made quite a bit of a return during the following quarter. So it just goes to say that you shouldn't be flipping strategies on and off whenever the market's down, because you just might miss that bounce. Taking a look at the 50 worst stocks for the first quarter, you'll notice that a lot of them came from the healthcare sector. Once again, substantially different from what's going on in Canada because of the cannabis names up here. When we take a look at the attribution relative to the benchmark, you'll notice that the estimate revisions are the exact opposite of what it looked like on the best 50 stocks. So they were actually higher to the upside, and the valuations were slightly cheaper as opposed to significantly cheaper. So if you were picking stocks that were pretty much in line with the index, you didn't get that much of a return. But if you were going deep value in terms of these valuation criteria, whether it was price to book or price to cash flow, if these were the metrics you were looking at in the beginning of the quarter, you actually performed significantly better. The other thing that's important here to notice is, if you remember from the previous slide on the 50 best stocks, all of these were heavily red to the left. These are the 50 worst stocks, which goes to show that had you selected stocks that weren't that affected on the downside in the previous quarter and have kept them in your portfolio, they might have weathered the storm during the fourth quarter, but they didn't provide you with much return. In fact, they actually were the worst stocks for this rebound. Just a little bit of perspective from different sides between the 50 best and the 50 worst. Taking a look at the historical performance of the second quarter, this is by no means an indication of what the future is going to be. It's not a forecast. It's just an evaluation of what has happened since 1970. What you'll notice here is that 76% of Q2 has been positive, and Q2 on average has returned 2.8%, with the lowest median at 2.5% and the lowest volatility, as represented by standard deviation, which came in at 7%. If we take a look at the breakdown of the sectors in terms of the second quarter historical performance, this data goes back to 1990, so almost 20 years. You'll notice that the best performing sector is the utilities, coming in at 4.9%, and the highest volatility sector, maybe as expected, is information technology, coming in at 11.2. Nowhere as volatile as it is in Canada, but still a volatile sector. In terms of the positive quarters, the highest positive sector historically in the second quarter has been healthcare, coming in at almost 3/4 of the time. Now, this is a test that we do on a quarterly basis. We basically take a look at the fundamentals that the market has rewarded during the quarter. We select a single variable, and we take the best 50 stocks, and as if we had selected those stocks based on that one single variable, and we see how they have performed. Now, what you can see here is that the best factor, had you selected it in the beginning of the first quarter, would have been the 5-year earnings growth number, followed by estimate returns on total assets. So from a single factor analysis view, those variables have outperformed the market during the first quarter. And on the bottom of the list here, anything that's below this red horizontal line, this is the index return, has actually underperformed the index. They've all returned positive numbers, but if you're obviously benchmarking yourself against the index, had you gone with price to book or price to sales as a single variable, then you would have underperformed the index. Let's take a look at the model performance of the US models that we have in place. What you can see here is that the top model, once again, is the dangerous model. This is very rare, as Jack has mentioned, and as Ian will actually dive into as well on the US side. He'll do a similar exercise than what he did on the Canadian side. You can see that the dangerous portfolio or dangerous model has outperformed by 10%. Now, notice the month of February. It has actually been the highest performing model in the month of February, and it's continued positive returns throughout. Now, it is rare, and then the models that lag behind the index were the most were income and earnings momentum, as you can see down here. Still returning 10%, 11%, but significantly lagging the leader and slightly behind the S&P 500. This is a Brinson attribution analysis done on our sister product, which is called Morningstar Direct. Some of you might be familiar with it. If not, feel free to ask us anything about it later on. But just so you understand this, this basically tells you which stock you've had in terms of overweight or underweight, and which has outperformed and overperformed. So a good example is, you see all the green dots on the right-hand side. This basically means that in the model, we had overweight that particular stock, and it has outperformed, thereby having the largest effect on our returns. So you can see the three names here, and I've circled them. These are actually the top three, Wayfair, as well as Diebold and Avon products. Now, what you'll notice is that all of these stocks have outperformed, but we might have not picked up on some of the stocks that have underperformed. What you have to understand is that this is an inverse model. When you're looking at dangerous, we're actually doing a contrarian strategy here. So you'll notice that all of these stocks that have outperformed have no strong fundamental metrics in them. Ian can dive into that in a little bit more detail as he goes into the dangerous strategy.
Yeah, thanks, Dan. So just wanted to comment again here on dangerous. What I've done on this chart is just compare the U.S. dangerous model against two of our more popular actually track strategies. So Canadian dividend growth and our large cap double 10 model as well. In the shaded area is the S&P 500. So again, dangerous is designed to underperform the market, and over the longest time, it certainly has. We're looking for companies that are shrinking earnings relative to the sector, over leverage, analysts don't like them. So basically anything that as a conservative investor you wouldn't really want to touch. So over the longest term, yeah, we have certainly underperformed the market, and we hope that that continues to do so. The U.S. market, as everyone knows, is very different than Canada. It's a much more efficient market. There's no real liquidity issues. Most sectors are pretty evenly represented. So you can see that the correlation, just by kind of eyeballing this chart here, the correlation on stocks in the U.S. is a little higher. So even though we're kind of picking up quote unquote junky stocks, the last 10 years have really just been it's been a really long bull run. And dangerous was not unexposed to that, right? So stocks in general have been doing very well over the last 10 years. Dangerous, I think, got hit pretty hard in the tail end of 2018, and of course we would expect that after a rebound, the dangerous stocks would probably do the best, and that's why I think that dangerous has done so well year to date. So year to date about 25%, where the index is up substantially less than that. I just also wanted to show you kind of a picture of the distribution of returns, again, amongst a couple of our more popular U.S. models. And when I say popular, I mean conservative type models. So the red bars are the distribution of dangerous returns. So it's not as obvious in the U.S. market. It's definitely still skewed to the left. So you'll see there's a number of quarters where dangerous severely shows a negative return. There's a bunch of them that are clustered around kind of the 0 and -5, and then some are actually positive. So certainly a higher correlation between dangerous and the index in the U.S., but it has been a very long bull run, right? So perhaps investors are a bit more risk-seeking at this point, maybe dipping in, trend following, or maybe picking up some of those less than desirable names simply because they are chasing returns. But again, for CPMS users who are disciplined and who are into the long-term fundamentals of the company, definitely not the way to go. What we're trying to do here is talk about why Dangerous is doing well. And again, when Dangerous does very well, our conservative models tend not to do quite as well. So I just wanted to show you the long-term picture here. If we go to the next slide here, this is just a calendar year breakout. There are a number of years, again, where Dangerous did pretty well. 1999, as an example, Dangerous was up 77%, again, during that tech bubble period. Again, you see something in 2003, 2009, after the financial crisis, and again in 2013 and 2016. So jump rallies are not uncommon, especially in the last 10 years in the U.S. Again, it's a difficult spot to be in because our models that people actually use tend to be a bit more conservative. So we will not be picking up those junky names. We hope that Dangerous will underperform in the long run. It certainly has historically. So just a matter of time before we look at that reversal on a Dangerous model, and that's where our conservative investors will be rewarded.
Thank you very much, Ian. Moving on to the market fundamentals and outlook. Just a few more charts for you guys here. Just hang in there. So this is a similar chart to what Jack had showed on the Canadian side. It's our go-to chart here. It's a very clean snapshot of what are you paying versus what are you getting. The ROE, which is highlighted in orange, is what are you getting, and the orange one, the yellow one, is the price-to-book ratio, which is what are you paying. What you'll notice is that the price-to-book ratio has actually bounced off of the same level that has been in 2016 and 2018 lows. So it's showing some, those undervalued times are behind us basically, and it's back into the area of the 2.4 price to book. What you'll notice as well is that this downward trending ROE, which has been getting eroded since reaching a high in 2014, has basically broken out and changed trend. So it looks like the ROE is continuing to climb, and we'll continue to track that on a monthly and quarterly basis. This is a chart of evaluations. We are looking on the top left-hand side at price to earnings, top right price to book, bottom right price to sales, and bottom left price to cash flow. You'll notice that the valuations have bounced off of their 2018 lows and are still a ways away from the recent 2018 highs. So depending on what your views are of the market, it could either be a little bit of a breather or it could be an indication of more downside to come. Taking a look at the earnings, this is a chart showing you the year-over-year earnings. And what you'll notice is that the EPS growth is expected to continue to drop further. This is exhibited by this dotted line here. This is essentially representing if 100% of the forecast were to come true, this is where that dot would end. So just so you can visualize that, obviously, there is very low chance of 100% of those forecasts coming true. So most likely it will land somewhere in between this dotted line. And keep in mind, this is also on a quarterly year-over-year basis. So it's looking at the previous quarter versus the same quarter from 1 year ago. The next chart is the year-over-year earnings growth of the S&P 500. The orange chart represents the aggregate earnings, and the yellow one represents the percentage change on a year-over-year basis. So you can see that throughout the years, minus a couple of, let's call them hiccups, in 2009, we've had significant growth in the aggregate earnings. What you'll notice as well is that the S&P, although it continues to climb higher with the growth rate, the growth rate is actually expected to decline from the mid-teens. So we're continuing declines from the previous quarter based on the growth rate that we're following here. This is another chart which is pretty interesting. The estimate revisions and the earnings surprise. So the 3-month estimate revision is deeper in the negative since the last quarter end, with the average earnings surprise slightly positive and in line historically. So you can see the orange line represented here. This is pretty much in line. The blue line here is the 3-month estimate revisions. So previous quarter end, it was about here and continues to decline further. So you can see that the revisions are to the downside. And this is also, just to note, this is not a level seen since 2016, 2015. So we're back to this area. If you're looking at it from a reversion to the mean perspective, then we're probably more towards the bottom than we are to the top. Breaking down the gig sectors in terms of some of the valuations here and the expectations, a couple of things to note here is that the estimate revisions continue to head lower, with energy sector pretty much doing a 180 on us. There was a 41% growth expected as of the fourth quarter, and it turned out to be a 24% decline. So that's quite the stark difference. So as you can realize, the energy sector is definitely not helping with the performance of the S&P 500. Also, the energy continues to be the cheapest sector at 1.2 times price to book value. At the end of the previous quarter, it was at 1.0. So you're pretty much getting 1 for 1 there at the end of the previous quarter. The other thing to take note here is that the healthcare sector continues to be the most expensive sector for the 5th quarter in a row. These are just the historical valuations based on the price to book. So just something to keep in mind if you do have a heavy weighing on the health sector within your portfolios. Some other considerations that we like to look at are the asset mix decision. You can see that the equity dividend yields remain below the 10-year bond yield since crossing over in late 2016. The zero line is represented here by this thicker gray line. So you'll notice that the majority of time is being spent below the zero. We've had a couple of periods in time, including the financial crisis, where we've gone above zero. But this gives you pretty much a good perspective on the asset mix decision. In terms of the economic snapshot, the unemployment rate ticked slightly higher last quarter, and the inflation rate continues its decline while the capacity rate continues to climb towards 80%, as represented by the red line here. This is just a zoomed in version, so you can see all the smaller ticks. Taking a look at another economic data is the consumer sector. You can see that the housing starts look like they were rolling over on a year-to-year basis. That's represented by the orange line. So you can see that as we've been climbing housing starts over the last few years, you can see there's a little bit of rolling over action. We'll keep monitoring that with a close eye. The personal disposable income is slightly high, and the retail sales have taken a step lower, as can be seen by this yellow line represented up here. Once again, this is a zoomed in version, so you can see the smaller gyrations within each of those variables that we're tracking. From a technical analysis perspective, this looks like a whole bunch of stuff, but basically what it says is the S&P 500 is back above its 50 and 200-day moving average and is on the way to test all-time highs as represented by this horizontal line. So quite the move. We had quite a sell-off there at the end of Q4. We've made it all back pretty much, but as we say, hindsight's 2020. If we knew that, then we'd probably all buy in on the last day of the year last year. So just a little bit of summary here for you. From a valuation standpoint, valuations are off of their 2018 lows, but still have room to run higher relative to their recent highs. The expected ROE across most sectors is in the double digits. And from the earnings growth perspective, it's relatively low expected EPS growth for the upcoming quarter. We've seen those expectations come down slowly. In terms of the asset mix decision, the equity dividend yields remain below the 10-year bond yield, and hence are proving the money is still favoring stocks over bonds, generally speaking. From an economic perspective, the inflation continues to drop lower while the employment rate ticks slightly higher. So a little bit different even from the economic data that we've seen over the last few years. And the technical analysis, as we just went over, the S&P 500 is back above its 50 and 200-day moving average, which is trending higher. Ian has a couple of things he'd like to say, so I'll just pass this over to him.
Yeah, again, thanks everybody thanks Dan and Jack for your presentations today. So this call we do, again, pretty consistently every quarter, around 10 days after quarter ends. You can always count on an invite to this call. It's always a very similar format, just to keep a very close eye on what's happening on fundamentals from a quantitative perspective. It's always interesting to keep up with that. Again, you're free to use any of this content. We will be emailing you a soft copy of this deck. So if you have a newsletter of your own or some of your own commentary, feel free to to take whatever you need. Just make sure you source Morningstar CPMS. A couple of housekeeping items here before I open the lines up for questions. As everyone knows, particularly those that use our U.S. service, we did make an announcement a few weeks ago that we will be changing our U.S. estimate providers. This is based on feedback from our largest institutional clients. They just noticed that the consensus numbers on the U.S. side of our service looked a little bit off. We've been using the same estimate consensus provider from the U.S. For well over 10 years now. They've served us very well. We have decided to change our estimate provider to someone else. We noticed that their data is a lot more robust. So for example, if you look at the S&P 500, our old provider had an average of about 9 analysts per stock, whereas our new provider has an average of about 18 analysts per stock. So the impact of this, I don't think, will be substantial. It happens on April 15th, so Monday morning when you come in, your U.S. CPMS service, you may see some changes in ranks just because we are changing estimate providers. But keep in mind, I don't think it's going to be substantial. We won't know until, for sure, until Monday. But we're taking the median estimate in all cases. So usually in our models, we use things like today's median consensus versus what it was 3 months ago as one of our indicators. So just doing the raw math on that, if you take a median of stocks, a median of analysts amongst, let's say, 10 analysts, that median number is not going to be too different than a median across 20 analysts, right? Especially because they're covering the same stock. So there will be some impact. We did run an analysis and we sent out the notes on analysis, I think late last week. So please, if you haven't read that, take a look at it. We do expect some trades in our in-house models, and if you have a custom model you're running, you may see a couple of things change around as well. So again, just to clarify, this only affects our U.S. Database. We continue to collect our own estimates for the Canadian side. So please be aware of that. So Monday morning, just know that that's happening. If you do have any questions, please feel free to reach out to us directly. You know where to find us. But please keep cognizant of that as we roll into Monday of next week.